In January 2021, one hedge fund lost 53% of its money, billions of dollars, in a single month. They weren't betting a stock would go up. They were betting it would die. Instead, it went from under $20 to $483 in days. And by the time it was over, a trading app had frozen, Congress got involved, and a tiny, dying video game store had become the most famous stock on Earth. So how do you lose billions betting against one little company? That's short selling. And by the end of this, you'll understand it completely, better than most adults ever will. Because here's the thing, that number, 483, sounds insane. The headlines made it sound like rocket science. It's not. So let's forget Wall Street for a second. Forget stocks. Forget the jargon. We're going to start with something a 14-year-old already understands perfectly, a pair of sneakers. Because once you get the sneakers, you get all of it. Your friend Jordan has the hottest sneakers in school. Limited edition. Everybody wants a pair. Right now they're worth $100, easy. But you've got a hunch. You think the hype is about to die. Next month, you reckon, nobody's going to care. So you make a move most people never even think of. You walk up to Jordan and say, "Hey, lend me your sneakers for a month?" He shrugs. "Sure." Now here's the genius part. You don't wear them. You don't put them in a closet. You immediately sell them. Today, while they're still hot, for $100, cash. Stop and feel how strange that is. You just sold a pair of sneakers that you don't own. They're Jordans. You only borrowed them. But the money? The money's in your pocket. There's just one catch, and it's the whole game. You owe Jordan a pair back. The exact same kind. Not the cash, the sneakers. So at some point, you have to go buy a pair and return them. You sold first, and you'll buy later. That is the entire trick. Everything else is just details. So fast forward a month, and you were right. The hype died. The same sneakers everyone was fighting over. Now they're sitting in the clearance bin. $60. So you walk in, buy a pair for $60, hand them back to Jordan, and say, "Thanks." Debt paid. He's got his sneakers. Nobody's upset. But look at what just happened to you. You sold for $100. You bought back for $60. You keep $40. Read that again, slowly. You made money because the price went down. That, right there, is short selling. Normal investing, you buy something and pray it goes up. Shorting flips it completely. You sell first, and you win when it falls. Now, in the real world, you're not borrowing from a friend named Jordan. You borrow the shares through your broker, the app or bank that handles your trades. And somewhere out there, another investor's shares get loaned to you automatically. You barely even notice it happen. But the deal is exactly the same. Borrow, sell, buy back, return. The only thing that's changed is the sneakers are now shares of a company. But now, let's talk about the nightmare. Because everything I just told you assumed you were right. What if you're wrong? Go back to the sneakers. You sold Jordan's pair for $100, betting the price would drop. But instead, a famous rapper wears that exact shoe on stage. Overnight, they explode. Now a single pair costs $300. And remember, you still owe Jordan a pair. So you have no choice. You have to go buy a pair at $300 to give back something you sold for $100. You just lost $200. And here's the truly terrifying part. It doesn't stop there. What if they hit 500, 1,000, 5,000? There is no ceiling. The price can keep climbing forever, and every dollar it climbs is a dollar out of your pocket. Now compare that to normal investing. If you just buy a stock for $100, what's the worst that can happen? It goes to zero. You lose your 100. That's it. That's the floor. But when you short, there is no floor on your losses. You can lose more than you started with. You can lose more than you have. That single fact Unlimited downside is why short selling is one of the most dangerous things you can do with money. So why on earth would anyone do this? Because when you're right, it's beautiful. Clean profit, while everyone else panics. The big hedge funds do it constantly, sometimes betting tens of millions that a company will fall. But here's where it turns from a smart trade into a horror movie. Imagine it's not just you who borrowed Jordan's sneakers. Imagine hundreds of people did. All of them sold a borrowed pair. All of them now owe a pair back. And then, the price starts rising. Just a little at first. One nervous person rushes to buy a pair and get out before it gets worse. But their buying pushes the price up a bit more, which scares the next person, who buys, which pushes it higher, which scares the next. Suddenly, it's a stampede. Hundreds of people all trying to buy the same sneakers at the same time, trampling each other, shoving the price through the roof. The more they panic, the worse it gets. They're trapped. Okay, now you're ready for the real words, and you're going to understand them effortlessly. When you bet against a stock, that's called a short. The percentage of a company's shares that have been borrowed and sold short? That's the short interest. And that stampede, everyone forced to buy back at once, driving the price higher and higher? That has a name too. It's called a short squeeze. That's it. That's the vocabulary the news threw at you. You already understood all of it, from sneakers. So let's go back to GameStop and watch it happen for real. GameStop was a struggling video game store. Lots of big funds were sure it was dying, so they shorted it, hard. So hard that its short interest climbed to around 140%. Sit with that number. More shares had been borrowed and sold than actually existed. A whole crowd of professional funds, all owing back the same shares. Then a group of regular people on a Reddit forum called Wall Street Bets noticed, and they started buying. The price ticked up. The funds started getting squeezed. To escape, they had to buy shares back, which pushed the price even higher, which squeezed the next fund. The stampede was on, from under $20 to $200 to a peak of $483. Melvin Capital, one of the funds caught in it, lost 53% in a single month and needed a $3 billion lifeline just to survive. It got so wild that on January 28th, the trading app Robinhood did something stunning. It switched off the buy button. You could sell GameStop, but you couldn't buy it. They later said their clearinghouse suddenly demanded 10 times more cash to cover all the trades. Regular investors were furious. The stock crashed over 40% that day. Lawsuits piled up. Congress held hearings. All of it over short selling. Now, it's easy to walk away thinking short sellers are just greedy villains who got what they deserved. But here's the twist that makes you smarter than the headlines. Sometimes, the short sellers are the good guys. Take Wirecard, a German payments company once worth tens of billions, a national champion. For years, a handful of short sellers kept screaming that the numbers didn't add up. People called them liars. The German regulator even temporarily banned betting against the stock. And then, in 2020, it came out. Around $2 billion on Wirecard's books simply didn't exist. The stock collapsed 98%. The CEO was arrested. The company filed for bankruptcy. The short sellers, the ones everyone hated, had been right the whole time. They'd spotted a massive fraud that the regulators missed. That's the other side of shorting. Sometimes the person betting a company will fall is the only one telling the truth. And don't think a squeeze only happens to little companies. Back in 2008, the German car maker Volkswagen got squeezed so violently that its stock quadrupled in 2 days, making it, for a brief moment, the most valuable company in the entire world, worth more than Exxon. Then it fell 58% in 4 days. Same exact mechanic as sneakers in a school hallway, just with hundreds of billions of dollars on the line. So, that's short selling. You borrow something, sell it high, and plan to buy it back low. Get it right, you profit while everyone else loses. Get it wrong, your losses have no ceiling, which is exactly why it can blow up a billion-dollar fund in a month. It's a powerful tool and a loaded weapon at the same time. And now, you actually understand it. Better than most people on the internet who argued about it for months. Just so we're clear, this is education, not financial advice. If the sneakers finally made this click for you, do me a favor and hit subscribe. One confusing money idea made simple every single week. Now, I left the advanced stuff out on purpose because it deserves its own video. How the funds actually borrow those shares. The fees they pay, every single day, to keep a short open. The dreaded margin call that can force them out at the worst possible moment. And the rules regulators rewrote after GameStop. That's part 2. If you want it, comment, "Yes, part 2, and I'll build it." And tell me honestly, after all that, are you a buyer?